This is not financial advice. I'm recording my thoughts about Airbnb stock. Airbnb, as we all know, operates a platform that lets the hosts to offer living spaces and experience to guests worldwide. And stock price is about $128, and in this video I'm going to talk about whether this is a multi-bagger opportunity or not. For that, we'll first look at the financials, and then I will also show the financial statements in detail to show what's actually going on. And finally, I'll show you the valuation. At $128 stock price, the market cap is about $81 billion. For the past 12 months, their revenue was about $8.7 billion. So that represents a price to sales of about 9, which is not bad. And the net income for the past 12 months is about $2 billion based off of $8.71 billion of revenue. That represents almost 23% net profit margin. The P ratio is about 42.75, which is expensive. Even the forward P of 30.67 is also expensive for this company. And in the most recent quarter, their revenue was about $1.8 billion, which represents 20% year-on-year growth. Remember this 20% year-on-year growth number. And the net income was about $117 million, which represents about 6% net profit margin. And even this $117 million is not a real profit. And I'm going to show how when I talk about the financial statement. Free cash flow is about $1.6 billion. This is strange for anyone who knows financial statements, right? Because free cash flow is equal to net income minus capital expenditure. So if at all, the free cash flow should be equal to net income or less. But free cash flow is probably 15 times more than the net income. So how is that even possible? We will look deep into the financial statements to know why that is. And this is one of the reasons why I'm not looking at free cash flow anymore as a measure of profitability per companies. If you look into me doing the valuation, I look at the net income and I do not even touch the free cash flow number. Let's look at the financial statement to explain this 117 million net income and why it is not real profit. As you can see on the screen, the revenue is about $1.8 billion. And the operating expenses are about $1.8 billion too. So there is no operating profit. If at all, there is an operating loss of $5 million. When you see a number in brackets, it means that it is negative. This 5 is in brackets because it is a negative number. So there is an operating loss. So how come they made 117 million net profit? That is because of the 146 million interest income that they have received. Airbnb's balance sheet is really good. They have about $8 billion of cash and cash equivalents. When they put that in bonds, they're getting some interest income. And that interest income is about $146 million. So this $146 million is added to the negative $5 million of operating loss. And then there is $11 million of other expense which got deducted. And eventually the taxes were about $13 million. And they came up with $117 million of net income. So if the interest income wasn't there, they made a loss. But at the same time, I do not disagree with this calculation because this is still real money. But I definitely question the profitability of the company when I see numbers like this, because you have to make an operating profit for me to buy into your business model, right? Now let's look at the bottom of the screenshot, which says $240 million of stock-based expense. If you pay $240 million of stock-based expense, that contributes to about $1 billion of stock-based expense in a year. Let's explain the free cash flow number, which was gigantic, $1.6 billion off of a $1.8 billion revenue, right? So I'm going to show a screenshot that explains this. As you see on the screen, the net income is the base number, $117 million. And stock-based compensation is given in the form of shares. The company did not pay cash to those employees, right? They just gave a part of a company. So that gets added back into the net income in the free cash flow calculation. And this is typical for most of the SaaS companies. And a lot of people do not realize this. They look at the free cash flow and say, okay, this is a great number. But how did that number come from? You are giving a lot of stock-based compensation, diluting the shareholders and showing that, okay, here's free cash flow that I have, right? So that's one of the reasons, like I said, I don't believe in free cash flow lately unless I really go through the financial statement. And Stock-based compensation was only 240 million, right? So how come they had 1.6 billion dollars of free cash flow? That's because of the unearned fees of 989 million dollars. As the name suggests, it is unearned. So it's a fee that they have collected in advance that they will provide services for later. So this is not really a free cash flow number if you think about it logically. It's like they collected the money and they have to offer services for that price, but then they're counting it as part of the free cash flow. Again, there's nothing wrong with this. There's nothing illegal in this, but it's just that it shows a different depiction of profit when an investor looks into these numbers without going deep into the financial statement. So this $1.6 billion is a free cash flow. They do have that $1.6 billion, but that's not a true depiction of their profitability. Let's now quickly look at the balance sheet. They have about $8.1 billion of cash and cash equivalents and $2.4 billion of short-term investments. And this close to $10 billion on their balance sheet is earning them interest income that they're claiming in the net income. So they will continue to get this for the next 1 or 2 years because the interest rates are going to stay high, and that is good for the company. That is still money, right? So I will account that when I do the valuation, and that definitely helps the investors, but I want you to know that it's not because of the execution of the company. It's because the interest rates are high and they have a lot of cash and they're taking advantage of that, which is good. Let's look at the financial outlook for future. In the next quarter, they're saying they can achieve anywhere between $2.35 to $2.45 billion of revenue. And this represents a growth of 12 to 16% year over year. And they're making it clear that this 12 to 6% growth may look smaller, but they have a really high number as base because the same quarter last year, there was a lot of pent-up demand in travel, and that number was huge already. So there is definitely some strength to their argument, but keep in mind 12 to 16% growth rate next quarter when we do the valuation. Look at the number of outstanding shares before we move on to the valuation. When you look into the screen, the number of outstanding shares is about 690 million for the past 2 years. So you can ask, how are they keeping this count same when they are offering a lot of stock-based compensation? That is because they are buying back those stock-based compensation expense and keeping the number of outstanding shares constant. And this is good news for the shareholders. And how are they going to deal with the future dilution? For that, the board of directors have announced in the past quarter that they can buy up to $2.5 billion of shares in the next few quarters or years. And this share repurchase program will help offset the dilution that is being contributed by the stock-based compensation. So this is definitely good news, and I'm going to account for this in the valuation. Now it's time for valuation. As usual, I'm going to show two cases, one with reasonable assumptions and the other with great execution. Let's look at the reasonable assumptions case first. In 2022, they made about $8.4 billion of revenue, and I'm estimating a growth rate of 25% for the next 5 years. Remember that in the most recent quarter, they grew their revenue by 20%, and in the next quarter, they're saying they can achieve 12 to 16%. So for me to assume 25% growth rate is actually optimistic. If you disagree, you can choose another number which is lower than 25%. With 25% revenue growth rate for the next 5 years, they will triple their revenue from 8 billion to 26 billion in 2027. With respect to the assumed net profit margin, I'm considering 15% because their operating margin was close to 20% and they have to pay taxes on that, right? So 15% I think is reasonable. You look at the past 12 months, their net profit margin was 23%, 2 billion net profit based off of $8.7 billion of revenue, remember? That was partly due to the contribution of the interest income that they are earning. So that's not real profit. Most recent quarter, the net profit margin was 6%, which also included interest income. So it's very dicey at this moment, but 15% is reasonable in my opinion for this kind of business. So with that, they will achieve close to $3.85 billion of net income in 2027. For a company that's growing in the 25% range and has a 15% net profit margin, I can comfortably assume 20% multiple. Since Airbnb is a very well-known and established company, I have to pay a little bit of premium. So I'll apply a 22.5 multiple, with which this company would be worth about $86 billion in 2027. With respect to number of outstanding shares, they currently have about 694 million outstanding shares, and they're continuing to buy back the stock-based compensation they give to keep this number constant. But I'm still assuming 1% dilution to be conservative, because this interest income is going to fade away once the Fed reduces the interest rates, right? So I'm not very confident that they're going to buy back the entire amount of share-based compensation in future when they do not have this interest income. So that's why 1% dilution seems reasonable to me, with which they will have 729 million outstanding shares in 2027. When I divide the 86 billion market cap with 729 million outstanding shares, I get a share price of $119. Currently it's at 128, right? That represents negative 7% gain in 5 years if I buy the stock now. Now let's move on to the great execution case. I'm still keeping the 25% revenue growth and 26 billion revenue in 2027. In great execution case, I'm assuming 20% net profit margin, because I'm assuming that Airbnb will get very efficient with their operating expenses and give us a better net profit margin. With that, Airbnb will have $5 billion of net income in 2027. For a company growing in the 25%, it has a net profit margin of 20%. I can assign a multiple of 22.5, but since Airbnb has brand value, I'm going to pay it a premium. So that's why the multiple is 25. With that, they will have $128 billion of market cap in 2027. And I'm assuming that there will be no dilution. Whatever stock-based compensation they offer, they'll buy it back in this great execution case. So that's why you see 694 million outstanding shares 5 years out. So that means no dilution for the 5 years in future. When I divide the $128 billion of market cap with 694 million outstanding shares, I get a stock price of $185. Currently they're at $128, right? So that's about 44% gain in 5 years, which is not a great gain. In conclusion, I'm estimating negative return in 5 years in the base case and 44% gain in 5 years in the great execution case. So both these cases are not at all attractive to me, and I'm going to buy Airbnb if it gets to $70 price or so. If it doesn't get there, I will not buy the stock. I'll just stay on the sidelines. Let me know your thoughts in the comments. Thank you so much for watching.